Hello investors. So today I want to talk about Discover Financial Services. The current share price is 36.18 and it gives it a valuation of $11 billion. Though this is a company that's selling at quite a huge discount compared to the start of the year. This company was around the 80s and now it's around 36, so easily being cut in half. Your big question must be why, because this is a company doing financial services. If you watch my video on banks have also been trading at quite a huge discount, because at the end of the day, there's kind of this, I guess everyone kind of feels like there's going to be a lot of default rates, particularly in financials, because a lot of people lost jobs, businesses are not running, so the default rate could be quite high. So the big question is, how badly will these guys be affected? So we're going to talk about that a little bit later. But first I want to just talk about the business. So currently in their loan books, their last loans for the fourth quarter in 2019 was about $95 billion. Out of that, 77 billion of that 95 was through credit cards. So you can only imagine this is a business that's very similar to something like Visa, MasterCard, except a lot smaller. Like, this is an $11 billion business, while you're looking at something like Visa and MasterCard, which is in the 2 to 300 billion. So this is by far a very small service in comparison to those. Though it's done alright in its own right. So you can kind of see they do student kind of loans as well, and personal loans, though they make up a very small segment in the scheme of things, less than 10% each, whereas credit cards is by far the big business. So the concern is, how well is the credit card business doing right now, and what's the chance of it not doing well? So if we can look at these financials as the last 3 years, you can see credit card loans, the interest income was quite phenomenal. You got it in 2007, 7.9 billion, jumping almost a billion to 8.8 in 2018, and then slowing down a little bit, but not by that much, and then jumping to 9.69 billion. So in terms of the revenue they bring in, it's pretty impressive. Like, other loans have just been increasing as well, and we'll talk about the total interest income, which is quite good, from 9.6 to 10.8 to 11.9. So when we look at these numbers, we kind of, we see a growing business. We see a company that's looking like it just, if everything's just remaining normal, this would be a really good business that just continues to grow. And then we can see how it just like translates down here all the way to net income. And the net income numbers aren't bad as well, because we've got 2 billion on basically 9.6 billion in income. So basically their margins are fantastic, to be honest. We're talking over 20% margins here, and in here 2.7 billion in income on 10.8 million revenue, and in 2.9 billion net income in last year on 11.9 billion, which basically 12 billion. So you can kind of see that this is an excellent business when it comes to margins. The biggest risk right now is how many people can continue to pay their credit cards, because you've got majority of it's like Discover, or if you don't know Discover, it's basically, they've also got Diners Club and all those kind of services. Anything with a, in any sense, the cards are where they earn the money. You've got the student loans and you've got the rest, but they're not the bread and butter of this business. The credit card is, and basically, I found this little snippet here where it says, coming off the heels of the Great Recession of 2008, credit card delinquencies were at 6.77% when you look at things in the scheme of things, if you're losing about 6.77%, that's actually quite a lot of money. So we have to consider round about here. If you lost 6.77%, you're more or less looking about 6 billion in losses. Like, that's just me just being a very simple my calculation, of course. But if we were to say this company wants to lose 6 billion in terms of its loans, how badly would it affect this company? It would basically be two years of net income. Though, basically it wouldn't be ideal for this company, but I think they would survive no problem. It's only 2 years of income. They just as they if they can come back, the company's worth. The company's much more smarter after that. Comes back stronger, and I think it's very it knows what it needs to do to bring itself back up. Of course, currently with government assistance everywhere, I think this company should be fine. If it needs a loan, it gets a loan. Um, if people need to like delay their current payments, I'm sure this card company will let people delay their payments. And then if we take a look at their balance sheet, and then we go, what is their current situation? So they've got about 6 billion in cash, so that's always reassuring. And then you've got your loans that will be continued to be serviced. The beautiful thing about financial services in a situation like this is, even if things aren't running, this company is still running because financials can operate regardless. They may not be making more loans, but basically anyone holding their cards is spending, and if they're spending, this puts money in the pockets of this company, and basically that's what's going to be the big driver. This isn't a company that has to have physical stores constantly selling. The minute you hold a credit card, you're just buying things, and you're basically helping this company earn as it goes. So I wouldn't be too fearful of this company not doing too well. Like, if we did get up to delinquencies for credit cards being 6.77%, then perhaps it wouldn't be too good. Of course, as it writes here, it gradually dropped back to around 2%. So we can see in the last 2 years delinquencies are in around about 2%. So even if we factor in that, hey, this is 2% normally, and they still make about 3 billion last year, then basically we're trying to factor in 4% difference, which if we go, okay, 4%, maybe that's 3.5 billion of that 9.95. And then how would this company handle it? I think it'll handle it fine. I think it knows what's coming. I think this time financial services are more than, like, they're very on top of things. They know these problems are coming, and they're actually working to help people like not default. So when it comes to this, is $36 a good purchase price? I think it's pretty good. I think this company comes back. I think you have to give it time though, because obviously people are not going to be able to pay their financials. They might, get a holiday, or they have to refinance to just stop defaulting. But I think even with defaults at this kind of value, I think this company represents some pretty decent value. And in the long run, I think you will do very well out of this company. So that's just my opinion. Of course, let me know what your opinion is on this company. Or if you've got any other questions, feel free to let me know. Until then, I think this is what I kind of feel like this isn't a bad company, and it's a P ratio of about 4. So you're kind of getting, if this is based on an assumption that people will default. Of course, credit card, people don't really normally spend a lot of money unless they run out of money, and they run to their credit cards, of course. So it's kind of a last resort in some cases. And if they were to default, then yes, this company could end up losing a lot of money. But I don't think the business goes into that much trouble because it should be prepared. It seems like it has the cash in the, it's got 6 billion to handle things. So yeah, I think and it's constant and it's still running, and it's not like a physical store that's halted and can't do any business at all. This business continues anyway. So that's kind of my view, that this would be a company that I'd be very comfortable buying into, even with the worry about financial problems coming in. Of course, you've got so much unemployment that's about to be hitting, the streets. So credit card companies may be a bit fearful, though I think at this current price, the risk to reward ratio isn't too bad. Of course, do a bit of research yourself and then make it your own decision. Until then, good luck investing, everyone.